Hey everyone, welcome back to Quants Worth Following. Today we have an awesome guest with us, Paul Aston. He is the founder and president of Tixall Global Advisors, an institutional portfolio management and quantitative advisory firm that specializes in active alpha overlay, algo trading, stat arb strategies in global foreign exchange and other major asset classes. What I love about Paul is he's one of the OG quant traders. Like he's been a quant trader, I believe, since like before I was alive. He has 3 decades of experience holding senior positions, leading quant trading groups at companies like he's been at Bank of America, Morgan Stanley, TD Securities. And then what's also interesting about Paul is he has significant entrepreneurial experience, having run Prometheus Quantitative Strategies, which is a stat arb fund. And then in the past, Paul was a PM and quant strategist at Barings, Santander, Putnam, and Columbia Management. And then today, his ongoing research projects include a variety of quant-related projects, predictive modeling in nonlinear, non-stationary noisy systems, detection of fundamental conditions for arbitrage using morphisms between filter banks, machine learning, microstructural economic models, optimal betting, and a lot more from there. So, Paul, it's really great to have you. I would love to first learn about how did you get into quant trading?
Thanks, Christina. Yeah, I always joke that the only reason I became a quant is that someone said I'd be working with exotic models. That's my standard answer for that question. But actually, it's interesting. I didn't start as a quant. I started as a musician, as a composer, and I was doing stuff that was, I guess you could call it artistically relatively quantitative, doing a lot of combinatorial work and information theoretic work in that art form. And I was also sailing competitively and started trying to figure out how do I gain an edge. And in my spare time, I would start reading about hydro aerodynamics of boats and things like that, and started building those kind of models. And then that kind of started morphing into effectively a more disciplined and analytic approach to doing things. And then I kind of formally gelled that in graduate school, where I started studying mathematical economics and then got into the markets. So that sort of started, I guess, in 85 when I was at Solomon Brothers as an intern, as a freshman in college. And then I finished my degree, and then I went and got a graduate degree and really entered the markets in 92. So 1992 on that one. So so got into quant back then, and that's really what inspired me. And arbitrage was a really big thing early on in my career, and so that's really what I wanted to try and focus on.
Amazing. I was going to say you've been doing quant trading for longer than almost everyone I know. Maybe just curious, what was the industry like back then, and how has it evolved over time?
Yeah, and apologies for the dogs in the background. They bark at squirrels at the window. So back then, it's really interesting. So my quant career, when I look back at it and the way the industry has evolved, was really shaped by the evolution of our kind of macro economy and the crises and the liquidity and regulations we've seen. So when I started, quant was really focused on derivatives pricing models, large scale kind of econometric models, lots of portfolio optimization, really sort of what I would call more macro scale predicting, more macro scale investing opportunities like that. And then as we saw more crises starting to pop up, risk became a bigger issue, credit became a bigger issue. And then we entered this large scale, long 20-year span of quantitative easing, where interest rates went to zero. And that meant effectively simple carry yields went to zero. And so there was no intrinsic yield left in markets. It became very speculative, very volatility driven. And what happened with that is I think that's what led to the rise of algorithmic and high frequency trading, because the only place that you could reliably predict and frac alpha out of the market was in high frequency liquidity flows, which never changed. They're always there. They're always very self-similar. But that's where we really saw, I think, quantitative trading take on this whole new realm and discipline and sort of evolve now into the modern type of trading that we see, which I think is driven very much so by data, by systems, by microstructure, and very high level data science kind of driven quant development skill sets that really weren't, they existed, but they weren't in the same demand in the same form as they are now.
Wow, that's amazing to hear. Speaking of that, I'd be curious about kind of the elephant in the room a little bit, which is AI. Curious on your thoughts on that as well.
Yeah, well, I think AI is outrageously powerful. Like, I think everybody was taken by surprise for how effective large language models were. And anybody who got to play with Chat GPT when it first came out was really impressed at its capabilities. And I think it's going to be very strong. I remember doing this stuff in the early 90s where we were trying to read headlines and respond to headlines and map that to like liquidity spikes and volatility spikes. And so we were using sort of tools to read streaming headlines and interpret what that might mean. But these models now have taken that to a far deeper degree. The technology and the ability to analyze and separate those features is so much more robust now. So the whole deep learning, machine learning, and neural network technologies have really evolved and become very powerful. But the big problem with them, I think, right now is it's really hard to understand what and why they're doing. As impressive as the outcomes are, it's really difficult to see inside that black box and to see how all those different connections are mapping to a solution. And so for the purposes of trading, as a statistical arbitrageur, what you're really trying to do is eliminate uncertainty. AI still introduces a considerable amount of uncertainty into your equation. So it's yet to be seen, I think, as to how effective it is, but it is a very powerful tool for filtering information and filtering data that is otherwise difficult to come by in the first place.
Yeah, I was thinking there's a lot of folks out there who are saying, oh, AI is going to be the future of all hedge funds and, it's going to dominate the industry and be smarter than any human. But yeah, I think you make a really great point. There's still a lot of unknowns maybe today and a lot more developments that we look forward to hopefully in this next decade, I hope.
Yeah, well, I mean, part of the ongoing research too, like when I'm doing a lot of work with like nonlinear, non-stationary prediction, the big problem for AI is that I don't know if it does well in those types of environments. Like it can probably identify and handle turbulence, right? If you fed it like wave tank information and you were like, okay, what phenomena is happening here? It could probably identify turbulent patterns and tell you something about it. I think it would be very hard pressed to predict what types of things are happening in turbulence and happening in noise. And our markets are really dominated by noise. And where they're really strong, like in large language models, is language is very redundant. Claude Shannon, in his book on the mathematical theory of communication, kind of showed how you can progress to greater and greater sentence structure and vocabulary structure just with information theory alone. So I think a lot of the AI and the LLMs are exploiting that structure in language, which is it's robust and it's redundant by its very nature. And the big trick to applying it to our financial markets is, well, what is the syntax and redundancy in the financial markets that then become predictable and exploitable?
Yeah, that's a great point. And thinking about how humans are irrational sometimes, and sometimes it's just hard to explain movements in the markets in any rational way.
Yeah, that's right. Well, and it's a bigger problem too. It's not well behaved. It's not a well behaved physical system. Microstructure will tell you, at least at the order book level, that there is physical phenomena, but what goes into the physical phenomena is not predictable, right? When you see phenomena coalesce, it can stick around, right? There's inventory effects and things. So you can use modeling disciplines such as like if you wanted to predict the path and evolution of hurricanes once you identify low pressure systems. That can help in financial markets to a degree, but what you can't help is sort of the whimsicality of what happens at the last minute.
Yep, absolutely. And that's probably why a lot of back tests look so perfect. And then you trade it in the real world and it all goes wrong. And you're like, why? My back test was so great.
Right. So just like markets are unpredictable, dogs are unpredictable.
Dogs are unpredictable too. What kind of dog do you have?
Yeah, we have two. There's a Shih Tzu and a Cavapoo.
Oh,
they look exactly the same because I think they have the same father. So
I love it.
Yeah.
That's so cute. So continuing on where we left off from, I'd be curious on what are some of the biggest lessons you've learned about the trading world, about quant, about the markets in general.
Oh, yeah. I mean, when you spend as much time in the business as I have, there's a point in time when you sort of start questioning everything you've done. I think the past 10 years, I've done a wholesale review of all the models I've ever devised and assess, well, why do they work or why do they not work? And the real epiphany that I had was most of your models really don't work that well when you think about them. They don't work as well as you think they would when you embarked on it as a quant. And so the big lesson that I've learned is that you have to boil down your problem to know exactly what you're trading and why you're trading and what you're going to get out of it, right? You have to identify the phenomena and say, well, why am I doing that? And there's a lot of first principles before you even apply quant to anything to understanding what that is. And so I think the biggest thing that I've corralled into very, very simple statements, like if I had to go teach someone who never traded before, what core principles to use to know how to trade. And the first thing I tell people is you really have to understand what the definition of statistical arbitrage is. And it's really simple in theory, right? There has to be a favorable asymmetry between payoffs and odds, right? So you can go bet on a coin flip and you can have no predictability. It could be 50-50 on the coin flip. But if you can identify a payoff in which heads pays more than tails, you have a statistical arbitrage. And so when you start thinking about trades in that fashion, your first order of business as a quant is not about predicting outcomes. It's more about siphoning data and looking for opportunities in which you know you're going to get paid in an outcome a certain amount, and you know you're going to get paid asymmetrically. And the greatest example of this is like think of a roulette table at a casino. Like the casino does not care which bin the ball falls into because they've engineered the payoffs to be in their favor and hence have a statistical arbitrage. And that's the difference between investing and gambling. So that's like first principle number one that I've distilled. And you always have to come back to that. From there, I think the big epiphanies are again now from first principles, realize what you're trading. And everything we're going to do is in a binary market. You can only be long or short effectively, which means you either are going to have an appreciation when you're long or a depreciation when you're short. So now the fundamental models become essentially Boolean, binary, negative binomial. You're waiting for a series of outcomes that are favorable, and you're simply enumerating those in permutations or combinatorial space. And those are your now fundamental models for what can happen with your portfolio or your position. And then your order of business from quant, I think, is now to make it really systematic as to how do you assign those two features that you absolutely need. You need to know for every event in your event space, what am I going to get paid, or what's it going to cost me for that event? And then what's the probability of that happening, or what information is giving me an edge? And you just go systematically through that space and look for opportunities that are in your favor, and then those become your bets. And then the biggest thing you have to realize is that none of that is right. And so you have to ruthlessly risk manage the process and never overly bet on a weak hand. Like you have to do a lot of thinking as if you're playing poker. Like people who survive to the last round in the World Series of Poker are never betting aggressively and unsystematically in early rounds. They have to survive as long as possible. And so you want to be really good at playing games with adverse information where there's more risk management and more betting discipline than there is attacking alpha. And that's the only way you're going to survive the game.
Absolutely. I'm curious, have there ever been any situations where maybe you had to rely more on your human instinct or, did something that might not have been as systematic as, not the systematic solution, but more the like emotional solution? Just curious on if that's ever happened and what happened after that.
Yeah, I mean, I think that happens all the time to a degree, right? So, I mean, a really good quant basically has to, at some point, divorce themselves from the model that they designed. Because in theory, all of the systematic information should already be contained in your model and in the process. That's what systematically happened. It should be very rules-based. It should be very rigorously applied to. Now, when you step back from that, understanding how that works, now is when you have to use the discretion. And the discretion is where you have to use your spidey sense or your macro sense or your risk sense for the intangible stuff that the human brain is really good at understanding and the model is not, right? You have to be able to manage the noise. And so that's really all the time happening that. But probably the best example that I can point to in my career was when I was running my equity stat arb strategy at Prometheus. I actually shut that down and gave money back to my investors on that fund. And it was because I wasn't getting the expected alpha traction on the process. Like everything back tested, everything worked out to have a very high alpha gain signal on it. And it just wasn't materializing. We didn't lose any money, but because the absence of that wasn't there, it required us to reflect and say why. And that's actually really what spawned my deep dive and expertise on microstructure analysis. And it all came down to suboptimal implementation and really not a deep understanding of how liquidity flows, double auction markets, order books, and all of that phenomena can vastly affect the outcome of what is otherwise a medium term or lower frequency implemented model. And so that experience is a great example of that, but that experience is also an indication of how your career can evolve based on learning experiences and things that can happen along the way.
Oh, for sure. I'm curious, what are some of the biggest lessons you've learned from starting now 2 companies?
Oh, yeah. I mean, so there's so many things. I think when you're starting a company, I think the most important thing is, first of all, you've got to know every company is going to have customers or clients, right? Even if you're trading on yourself, you have to understand what are the pain points and needs of your customer. And if you don't know that, then you're in trouble, because nothing you're going to do is going to solve it. You're really not going to effectively get paid. So you really need to understand what the pain point of the customer is and deliver very succinctly and uniquely with an advantage into that. And then there's the chicken and egg problem. The chicken and egg problem in starting a business is my customer's pain points something that I'm already really good at? Or is that something that I need to become good at or actually evolve? And a lot of times I think as quants or even as eager entrepreneurs that you dive into something, you have a passion, okay, I might have a real interest in this, and maybe you're not that good at it, but you dive in, or you're good at it as well, but you don't really know the customer base yet. And all you end up doing is spinning your wheels because the revenue model is missing. The argument is missing, the application is missing. And again, you go back to that fundamental principle of stat arb. It's like, well, what's the payoff? It's like you could have a very high probability that you're going to have a great product and everything comes out nicely, but if the payoff is not associated with it, you don't have a business. There's no income, there's no revenue, there's no earnings, there's no gain in the system. So that's probably the biggest thing I've learned starting a business. And then, as you probably know, the ancillary things is you have to really learn to trust people as far as you can throw a chimney by its smoke. So basically be ruthless in having contracts and communicating things up front. And if anybody balks at that communication and clarity and putting things in writing, then you absolutely cannot engage in those types of relationships, because it's always going to be a point of contention, and that becomes at best distracting, at worst can force you out of business. So really important to make sure everything, again, is highly systematic, highly contractual, and then you have to ruthlessly manage to a budget. So you cannot waste time and money on lawyers, vendors, accountants, systems. You can't spend too much. You really should spend your time trying to do as much of that yourself, even though that's not the most efficient way to do it. But you have to spend time trying to do it yourself, because until you've done it yourself, you don't know what's involved. You don't know what's being the value of what somebody can deliver who's better at it than you are. And then you also don't know the appropriate price tag to pay for that stuff. So those, to me, are the biggest lessons that I've learned in starting businesses and making sure you're successful.
Yeah, that's I echo you on that too, by the way. Like, one thing I didn't learn until it was too late is you got to learn how to sell, right? Whether that's if you're running, even if it's a trading strategy, you got to test out the markets and see if this is actually going to work, right? Before you actually focus all your time and energy on building all the infrastructure and learning about the microstructure and the latency and whatever else you need to do. And then you're absolutely right about also focusing, because there are a lot of distractions out there. There are a lot of things, lawyers, people who are going to want your money. and at some point, you just have to do it, right?
Right. Yeah, no, I mean, so I have the benefit of having done a stint right after college at a really prominent law firm for one of the best litigators in the country. And so I spent a year and a half doing that before I decided I was going to go off to grad school. So I had enough legal background doing case law and seeing contracts and stuff that I feel like I'm competent enough to write my own agreements and things like that, or at least I can read something. Like, I'm not foolish enough to say that I can do that, but for most of the boilerplate, I kind of know where I can go find like templates and precedents and things like that in order to raise what I need to do. And I can get 90% of the way there in agreement. And that's a massive savings, because if you have to pick up the phone to your attorney at $1,000 an hour every day to do something for every little contract and employee you're going to hire or this or that, you'll end up having a budget of 100 to 200,000 bucks a year that could otherwise be deployed easily into your business. And for a starting business, that's a giant number.
Yeah.
That's a giant number.
It really is a huge number. Absolutely. Just one final question. What's next for Tixall Global Advisors?
Yeah, so, as we continue to work and build our business, the big thing here is, let's perfect our active alpha overlay. And what that is that we hedge foreign exchange for institutional investors, which is a really expensive and not always perfect outcome for that. So our alpha is substantially lowering the costs of hedge implementation and collateralization and the cost of putting on and rolling transactions. But then we also meld that with like active alpha, like alpha generating pure hedge fund types of strategies to basically ensure that those costs come down, or you could even like generate diversification in an independent form of returns for the program. So we're basically building that out, perfecting the systems behind it with live capital and a live client in size. And then the goal is going to be to like grow those assets and that responsibility to a really respectable size, which would be, $1 billion plus. And so that's the game plan over the next couple of years. And then from there, there's all kinds of things that spill off of there that we could take advantage of. Like if you have that competency, you can move into offering liquidity and doing things like that as a separate business to your customers and the market in general. There's specialized analytics and systems that are part of our overall process that are non-proprietary that could be spun off. So there's a whole bunch of things that are going from there. But right now, the focus is really growing that core business and competency set.
Amazing. Congratulations on everything.
I'm
really excited to see you guys continue to grow. And we'll post all your website and everything below in all the comments sections of everything we post on. So if folks want to be able to check you guys out, they'll be able to do so as well. So thanks everyone for watching this, and I hope you all take care, and I hope you've learned something new today. Take care. Bye.
Awesome. Thanks, Christina. Bye.